we're having a lot of activity in the Bronx. It's all about following the money. It's all about listening to the people that are doing deals in the Bronx and what they're looking for and what they want to buy. And these conversion properties have been, I mean, maybe I shouldn't be going on here saying it, but I feel like the cat's out of the bag. They've been a gold mine.
You know, we're getting requests from banks for as much as 20 or 25% compensating balances on construction projects. In other words, if you're going to borrow $10 million to do construction, they want $2.5 million in deposits for the life of that loan. Basically makes it a non-starter for most people. And a lot of that work has actually migrated away from the banks to debt funds that couldn't care less about your deposits.
I can't look at a single point in time when there's not like that arbitrage where there's that spread where buyers are willing to overpay for a certain asset class and the sellers don't realize it yet. So there's more demand and capital than historic values. There's always that angle. And if you can find those.
All right, Derek, Andrew, welcome to the Broker Brunch. Thanks for coming in. I know it's the day before July 4th. Appreciate you both making the time.
Thanks for having us.
100% thanks.
So the reason why I wanted to have both of you on, I feel like you're in very unique positions. You're young, hungry guys, even though we said off air that you're not feeling that young these days. But you're both in the trenches as well in building a brokerage. You're presidents of your own firm. So I think it's really special to hear what you're seeing out there because this is chaos out in New York right now. I'm building a team. You guys have built brokerages. I can only imagine the amount of challenges that compound at that level. To kick it off, because I know it's hard for brokers to be brief, Derek, in 5 words or less, what do you do for a living?
I sell buildings.
Andrew?
That's an interesting answer.
Stop stalling.
Jumping in. Yeah.
I sell a mortgage brokerage platform.
Yeah, that works.
I was going to say, yeah, you provide financing for property owners.
But I think I provide a platform to my brokers and what I'm seeing as the platform.
For sure. So
I mean, I still use brokerage too, like you do.
We've built a platform, no question about it. But what I do, I'm on the broker side. I sell buildings, and granted, I'm running the brokerage, but and the platform is going great. But what I do is sell buildings, and then I run a brokerage, kind of on the side.
It's an interesting way of looking at it.
It's funny because I would invert those. When I think about what I'm supposed to do, I think I'm selling a platform to my team of brokers in exchange for a portion of their commissions, right? And I need to always be thinking about how am I optimizing this platform? How can I make this platform better? How can I help them make more money? So that equation is always balanced. Yeah, they say I'm getting what I'm paying for.
100%.
And the better that value proposition is, the better my retention is, the better my hiring is. And me doing deals is like, is something I like and something I still do, but for me is the sidecar. At least
Yeah.
how I think about it.
No, so for me, I've always loved brokering. It's been my passion, and I don't really love running the business. I feel like we've kind of created the business and run the business for the benefit of brokering deals, and so that we could be better brokers. We have the resources, and we basically have every tool at our disposal. And so we've used the brokerage essentially to give the brokers what they need. Myself being one of those brokers, and it's ended up being a phenomenal platform.
Yeah.
Let's talk about that for a sec. So IPRG, right? You've built a brokerage, you've boots on the ground across the city and New Jersey.
That's right.
What's been the most surprising thing that happened in 2025 that you weren't expecting?
In 2025, we're halfway through the year. It's I don't know. It's been a very good year. It's on pace to be our best year yet. I guess the biggest surprise, or the thing that I didn't expect, we're on pace. We're doing great. We're still doing great. We had a really good past couple months. Q2 was huge for us. But seeing the way that the talk about tariffs impacted the stock market and then impacted the real estate market, there was like a notable like dry spell. Not dry spell, but things really slowed down for say 6 weeks when the market was uncertain. So that was like, I guess, the most surprising thing. And it was just a good reminder that the real estate market is really closely tied to the stock market. And when the stock market is doing well, I feel like real estate values do well, and there's a lot of liquidity in the market. It's a lot easier to sell properties. And when the stock market starts to go down, the real estate market really tightens up. So that was the most surprising thing.
If you've been wondering what types of deals we've been working on,
We've made it easy for you. Just click on the link show notes below.
we're talking real deals and real opportunities.
Whether you're an investor or owner or just curious to know what's going on behind the scenes.
Just click the link below and it'll bring you right to all of our available inventory.
Andrew, for you, it's less about boots on the ground with Dansker Capital, right? You're more of a national platform, I would say.
Yep.
So what are you seeing, say, outside of New York? Have you been surprised by how New York compared to other markets? Is
For sure.
capital escaping New York and searching for other places?
It definitely is. I mean, I would say if I was to pick a surprise to back up to your other question of 2025, it was how much work picked up in New York for us. But when I started the brokerage 5 years ago, I want to say 75% of our work was in New York. And I would say today it's almost totally inverted. That probably about 65, 70% of the work is outside New York. And the other markets, the Southeast, Florida, have been much stronger in terms of transaction volume from what we can see.
Have you built your firm to reflect that velocity?
Oh, absolutely. We have a half dozen people in South Carolina. We're hiring I think we're hiring the third and fourth next week for Miami. So we're very much growing in those places, which is also connected to New York. They're not totally separate in the sense that someone who retires from running something in Brooklyn, sells it, buys a triple net in the Carolinas and retires, the flow of those markets are connected, and the work we do down there is often tied to clients here.
I'm gonna circle back on the team building because
Yeah,
I
of
think
course.
it's really interesting. I want to also hit on just what's going on today. There's obviously a lot of news in New York. Most recently, the mayoral primary for the Democratic nomination. So it looks like
I didn't read about that.
Zoran Mamdani is going to be the presumptive nominee. So if that comes to pass, we have a self-proclaimed socialist as mayor, and not in the sense that folks say, "Oh, he's a socialist." He's an actual socialist. So, Andrew, are you seeing this being reflected already by banks in the market, or what effect is it having on real estate in New York?
Yeah, I haven't heard from the banks yet about what their opinion is. I've definitely heard from sponsors and brokers about deals that were at the finish line that have collapsed because everyone wants to retake stock. Absolutely.
We haven't seen that at all.
Definitely.
Granted, I mean, I think the real question is like, let's say he becomes mayor, how does that actually impact real estate? I think that's what I want to understand is like, where is the impact on real estate? And he's talked about rent freeze. So obviously that impact is on rent stabilized product. And he's talked about raising property taxes, although I don't know that he's able to do that. And he said in whiter, richer neighborhoods, I think he's mostly alluding to brownstone, Brooklyn, and brownstones and condos throughout the city. So that will impact residential real estate. I'm not so sure how it impacts investment sales, especially for the stuff that we're selling where we're doing, land sales or redevelopment deals or, cash flowing properties. So for us, I mean, we haven't seen a pullback at all. I mean, we've had a number of contracts signed this week, accepted offers this week. We have bidding wars on properties that are like multiple contracts out on deals.
But Derek, what about the rent stabilized product? If he freezes that rent stabilized multifamily world, I mean, these landlords are going nuts for the last 6 years. They're already, I feel like, on life support.
Yeah.
Is this the final nail in their coffin?
I mean, for some, it's going to be. I think it really is a function of what their debt situation is. I think for people that are levered, even conservative financing, I think it's going to be really tough. And I think for other owners that don't have any financing on the property, they'll get through. But it's really tough. I mean, it's a really unfortunate situation. I feel like the rent stabilized owners have just been the beating horse of the market, of the industry. And I don't think it's fair, but that's where we're at.
I think to your point about buyers in the market, if you're buying rent stabilized assets right now, it's not for short-term upside anyway. Yeah, it's a basis play for the long term. And so, who cares what happens in the next 4 years? You're buying that for looking 10, 20 years out, I think.
And yeah, I mean, these owners aren't relying on the rent increases to like make or break their deal. I mean, it's such a small amount to begin with, and they know that going into it.
Yeah.
But I think to take a step back for us as brokers, I mean, my whole thing is I want to follow the money, follow the liquidity, and there's always demand and capital that wants to be invested. And we just try to find the product and find the properties that capital wants to be placed into. So
what is that right now?
right now it's really anything with development, land, townhouses, conversion properties. There's a lot of 1031 capital for free market renovated buildings, stuff that was already renovated. We have contracts flying around on free market buildings, whether it's like retail or office or industrial or residential, stuff with air rights, vacant product. There's a ton of capital for this. And it's also nice about these kind of properties is there's like clarity in place with like 485X or City of Yes or just the programs that exist. People know what they're getting into. It's not like a moving target in a way where you could say the rent stabilization market has been kind of a moving target with the laws changing and the taxes keep going up and you don't know what's going to happen with all the regulation and that kind of stuff.
I would echo that. I mean, I think that among what we've seen in the city, a lot of it's been either free market or development or redevelopment. And it's definitely an allergy to rent stabilization that we see in terms of
we did just close a couple rent stabilized properties in Chinatown, and those are bought by Chinese local investors. And I don't know. I mean, I guess on another hand, like it's just a matter of finding sellers that, will meet the market and that are realistic about selling, because everything is sellable for a price. And maybe the price isn't what it used to be or what they expected based on like a few years ago.
Yeah.
But if they're real and they want to sell, there's a market out there. It's still New York City.
It's still New York City, and I do think every day I'm grateful for that we are in New York City, because as tough as it is here, I mean, you look out the window here, we have something that nowhere else has. And I think it's a lightning rod for people, for capital, even though I know it's probably got more challenging, but it's still New York City. There still is a buyer once a seller is willing to meet that market.
I think that's true. I think to your point, or maybe it was your point about the debt, that's a key factor in whether or not that sellers can be able to meet the market, right? If you borrowed in the last cycle, really far up the stack and you're at 65, 70 on the last valuation, you might be underwater or
with low interest rates, even like debt service coverage at like, what were rates back in 2020? 3.5%, 4%?
Yeah, they were. Right.
And now they're
probably 6.5 today for a conventional debt.
That's a big issue in terms of when the loan comes due.
Totally. And especially if it's a rent stabilized asset where, we all know expenses are growing. We all know inflation's real. Rents haven't grown that much. And if you don't have a deregulated or retail component there to make up for that, you don't figure for the refi.
Are banks requiring payoffs at this point, or are they like it was extended pretend for a little while?
We're still doing a lot of that.
Yeah.
We're still seeing a lot.
So I'm seeing a lot of people selling, and it seems like the lender's kind of forcing the sale.
I mean, everybody knows that they can't refi those assets. I mean, the bankers can do the same math that everyone else is doing, and they can see that they don't figure. And, no one's going to extend a fresh loan at 90% leverage. Your existing lender is going to carry it IO or extend the amortization or whatever to carry it. That's the only way you're going to keep that going, which everyone has an interest in doing. The bank doesn't want to waive a foreclosures. I mean, they want their money back. It's the irony of banking. They want the money out and then they want it back as fast as possible, but then they just are going to put it out again. But, they don't want to force the issue.
Got it. Yeah, it makes sense because it's like a partnership. They need the owner to manage the property and do a good job in terms of maintenance, of course, paperwork and property condition. So it's definitely in their interest to work together.
Totally. And I think, it's been interesting. I think people have been waiting for the storm to abate, the interest rate storm.
Mm-hmm.
And we just haven't gotten there. It's just been a long wait.
It's created a lot of for sale situations.
Yeah.
It's the perfect segue into interest rates. So at the top of the year, we were thinking, okay, so there's a new administration, pro-business, interest rates are going to come down. Hopefully, maybe you didn't bet it. Actually, we sat down a year ago and I asked you about interest rates. And
I only want to know what I said if I was right.
You pointed out that and I think you were right, it's less about interest rates and the focus should be more about capital availability.
Thanks for listening to the Broker Brunch. We've now brought you a ton of episodes and we hope we're providing a lot of value. If you have any ideas of people you'd like to see on future episodes, please drop it in the comments so we can make it happen.
And that is still an issue, especially in New York more than other places. I was talking to someone this morning about who's a lender for Fannie and Freddie. And he was asking me about what the environment of bank competition looks like for his product, because agency debt's pretty inexpensive right now. They got a nice tight spread, which obviously then figures better on the leverage point. And I said to him, it's still quite thin in New York, maybe even worse than when we sat down a year ago. There just aren't a lot of bidders on any project, certainly not at a viable number, at least.
Would you say it's a broken system right now in terms of bank competition?
I wouldn't say it's broken. I would just say that to me, there appears to be a very real opportunity. If I were a lender, I would be looking at the market today and saying, okay, the assets are trading at 65% of what they were trading before. Correct me if I'm totally off.
Depends what the asset class is.
So call it 60 to 75, 60 to 80% of what it was.
It depends. I mean, some cases they're trading for more
than before.
Well, it depends what asset class you're referring to. There's so many different like asset classes and value ranges.
If you look at rent stabilized in
Yeah,
the
rent
Bronx,
stabilized.
right, which is where I spend most of my time, not so much rent stabilized, but the Bronx, you're probably about 40 to 60% down in values from 2019.
Okay, so let's just call it, you're going to get an asset that's trading at 60% of the prior value for rent stabilized asset in the Bronx. And the rate you're going to get as the lender is double what it was, to your point, from 5 years ago. To me, I would want to be in at 60% of the basis at double the return. To me, that looks like a great opportunity for a lender to grow their book. I think the issue is many lenders are constrained by their existing assets. They've got a book filled with loans, to your point, that they can't roll off, and they just don't have the leeway either due to their ratio of how much real estate they have or available capital to go out and capture that opportunity. So I wouldn't say it's broken. I would just say there's an opportunity for somebody.
To their capital constrained, the lenders,
Totally.
based on their existing book.
Totally. Yeah. I mean, if, their
Well,
whole
how do they
system is built to roll off and put on new, right?
So if they're not issuing new loans, like how does that look for the bank in like the course of the year?
It's a profitability issue.
For sure, profitability issue.
Right. Absolutely.
Why? Because of all the fees.
Origination fees and blah, blah, blah. Yeah. And also, some of those rates they're resetting to where the market is. So it's helping deal with the issue. But the legacy assets that normally wouldn't be held to term, right? Usually like a 5-year loan on average is going to be held 3.5 years average, right? Those are being held to term because there's no way out. So they're carrying that legacy book of low interest rate stuff even longer.
And in some cases, they're extending further.
Right.
Yeah.
Usually when they're extending, they're picking up a little bit on the interest rate, right? So it'll be, okay, you were in at 3.5 on 30 or AM. Now we'll roll you over. You're going to be at 6.5 IO.
Mm-hmm.
It's pretty close to figuring where that 3.5 on 30 figured, or 3.5 on 25, probably closer to that.
Is that good for their profitability, or their profitability is mostly tied to fees and issuing new loans?
I don't think it's great. It certainly helps to pick up the interest rate, right? But they're losing all the fees, all that turnover. Yeah, it's a problem. Yeah, it's definitely a problem.
Derek, you said something really interesting there that was contrary to what I was going to go, or where I was going to go, that the interest rates are actually causing a lot of folks to sell. You're seeing an uptick. Whereas I was going to say, are the interest rates dampening the market completely for demand?
I mean, a lot of it is debt issues, right? You're seeing it where people are like forced sellers, essentially. They can't refinance, and I think the bank wants their money back. So if the bank decides not to extend the loan comes due. And I'm starting to see a lot of these rent rolls coming in where the loan was taken out in like, say, 2020 or 2021. And, I just use a rough like rule of thumb, 10 times the NOI. So I get the rent roll, I can underwrite it, I see the NOI, I see what the loan is, and I'm like, well, I mean, this guy is going to have a lot of trouble refinancing this when this loan comes due. And if the bank's not working with them, I've sold so many properties where the owners never wanted to sell. They never expected to sell. That was never in the cards. Like, these are properties that people intended to own forever. And then here we are, sending out contracts and signing contracts. And people seem perfectly fine with it. It just is what it is. Like, they didn't expect to sell. They didn't plan to sell, but they need they need to sell, they need liquidity, and they want to save their equity at this point, and everyone just kind of keeps, moving forward. So yeah, I think the interest rates environment has created a ton of activity in the investment sales landscape. But to Andrew's point, it makes it very hard because you have the whole financing issue for the buyers, and also for the owners. How are they going to refinance the property as well? So there's a lot of issues there.
Mm-hmm.
And
And we've got another issue for those buyers those sellers that had been buyers on exchanges, right? Because if you exchanged into your property and then you're going to go sell and your debt's at 90%, you need to do an exchange out of that.
that is a huge issue.
Huge problem.
Huge problem.
You're trapped in there.
Or you're supplementing, but I feel like a lot of buyers are coming along and they're trying to get cute, thinking like that the financing market's really hard and that they can get better deals from sellers because of it. And they drag their feet, or they ask for different terms and contracts. They sit on a contract and then boom, someone else comes along and the deal gets signed. I mean, I'm surprised at how much activity there is in the market. Honestly, how many deals we're selling, how many contracts, how many accepted offers. Like, the market, especially given the interest rates, the market is much more active than I would have anticipated.
Brooklyn's a different animal though, Derek. I feel like you're looking at it's a tale of like two cities.
Our Bronx team, I think we have like 20 deals under contract.
Listen, we're selling it one deal a month in the Bronx. I mean, we love the Bronx. That's where we're growing. But in terms of demand, if I put a deal out in Brooklyn, if I put Brooklyn in the subject line of the email, the rate of response is 5x what it would be for the Bronx. The thing about the Bronx is that the Bronx is amazing. It has a lot of potential, but unless you're already in the Bronx, it's very difficult to attract people to come to the Bronx. So
Why do you think Brooklyn has such attractive power?
I think Brooklyn is a global brand. I grew up in Ireland. People wear hats that say Brooklyn on it. Brooklyn has been a phenomenal success story, and whether it's the Brooklyn Nets, Jay-Z, just the brownstone nature of the city, it really has been an unbelievable success story outside of real estate from a marketing perspective. I think Brooklyn is really something special. I think I read it was either the second fastest growing city in the country, which is not surprising. If I drove along Atlantic Avenue a few weeks ago and you feel like you're in a different city, you're in somewhere in the Northeast, but it's got its own feel.
Depends where you are in Atlantic Avenue.
Well, so this is a great point, right? So I drove out and I went through all of like Burham Hill and then
beautiful.
and drove out, and then I ended up in Crown Heights, right? Because we're selling 2 properties there. But like I could see all that had happened in the rearview mirror as I was driving over the Brooklyn Bridge, and then all of a sudden I could see where the growth was coming.
Then you just rezoned that whole stretch, so it's about to get crazy. There's about to be a lot of new buildings there.
So I think when you say it's great to hear what you're seeing, because I feel like that's really encouraging as a real estate market. But I know on the day-to-day myself what I'm seeing uptown and the Bronx, and it's we're not seeing what you're seeing, but you have to take into account 70% of our market is rent stabilized
Here's my
product.
perspective on that. We're having a lot of activity in the Bronx. It's all about following the money. It's all about listening to the people that are doing deals in the Bronx and what they're looking for and what they want to buy. And these conversion properties have been, I mean, maybe I shouldn't be going on here saying it, but I feel like the cat's out of the bag. They've been a gold mine.
When you say conversion, you mean office to
multi, or you have like
multi to co-op?
You have good residential, like bulk density zoning in the Bronx, and you have like these little houses, like 2 families, 3 families, 4 families on like 20 or 25 foot lots. Not big properties,
right?
But these things are just selling like crazy.
Perfect switching of gears here to City of Yes, right? Because City of Yes came in earlier. It was technically the latter part of 2024, but it's been a big topic in 2025 for the first half of the year. Plan is to deliver 80,000 more units over 15 years, which sounds like a big number. When you actually think about it, it's not that crazy for a city of 8 million people, but it's something. And I think as a broker, we have something to sell right now when it comes to development, and that was missing for about 2 years since 421A elapsed. So now we have 485X, which replaced 421A, a little bit of a watered down version. Combining them with City of Yes, are you seeing, Derek, that this has really uplifted development demand across the city?
So it's hard to say specifically on that. It seems like it. I mean, you have higher FAR in certain situations, and it seems like with the 485X. Like there's a lot of overlap in terms of the programs. Just like anecdotally, there was a property that we were selling. It was I forget the specifics. It was a few months ago, but like the house was like the property is set back in the lot, so like any new development would need to line up with the adjacent properties. But that left it so that you like with the 30 feet of light and air that you needed in the back, like you basically had to build a skinny building or like a taller building. And with City of Yes, I think they shortened the light and air requirement from 30 feet in the rear to 20 feet. And the developer was able to do one less story, which was, economically beneficial to him. And it made the deal. So it was a property that we couldn't sell. City of Yes got approved. We sold it. So I was very happy about that. But, again, I think money just wants clarity. It just wants to know, like, what the program is and how it works without this whole moving goalpost, shifty type of environment. Like, the uncertainty just creates paralysis. And I think that's part of why the rent stabilized market's having so much trouble, and the fact that there's no rent growth. But there's expense growth and there's NOI erosion. So it's just a very tough asset class to buy into when the taxes keep going up, the utilities keep going up, the rents aren't going up. It's a ton of work. So like, honestly, I mean, we used to sell so much rent stabilized, but you know how many buyers are calling me saying like, hey, I want to buy a 20 unit rent stabilized building. You know how many times I've gotten that phone call this year? Zero.
Yeah.
Zero.
Of course.
So
Like a walk up that's just got no business plan, because you can't raise money for it, and it's. But I want to focus on City of Yes right now for a moment. How are banks viewing development? Is City of Yes helpful or does it hurt?
So I would say, to begin with, a lot of the development work we've seen, which is limited to begin with, is actually focused on debt funds more than banks in terms of the debt side execution. In the past several years, banks have had limited capital, limited appetite for risk. We've seen banks really pull back from the ground up market, and also the major rehab market, but specifically the ground up market. And, we're getting requests from banks for as much as 20 or 25% compensating balances on construction projects. In other words, if you're going to borrow $10 million to do construction, they want $2.5 million in deposits for the life of that loan, right? That basically makes it a non-starter for most people. And a lot of that work has actually migrated away from the banks to debt funds that couldn't care less about your deposits.
Can you explain the difference between a bank and a debt fund and, say, agency debt?
Sure. The bank, for the most part, is going to originate. When you say explain the difference between in terms of what the execution looks like or what the back end looks like.
Just who they are.
Who they are. Yeah, that's what I thought you meant. Okay. The bank is taking deposits, using that depository base to borrow money, and then take that collection of money and lend it out and keep that loan on their books and collect interest. They make money through the difference between the interest on what they lent out and what they're paying on deposits / their borrowing costs. That's a traditional bank. A debt fund has no deposits, simply borrows money against the assets they hold, which is mortgages. And so that looks a little different. They don't need deposits. They're not regulated in the same way. And that influences the structure of what they're able to offer.
Who would be an example of a debt fund?
So you've got big debt funds, you've got little debt funds. I spend a lot of time with little debt funds like W, Trebian, Maxim, all, I think, household names in New York, Hirschmark, who are doing, call it 1 to 50 million, which is where I spend most of my time, deals all over the city.
And they're providing or filling that vacuum right now where banks might be missing and debt funds are seeing opportunity.
Definitely. There was a lot of talk for a while about how debt funds were going to take over the banking world because the banks weren't able to be quote unquote competitive. I don't think that that's a reality for a lot of the banking world. I think that construction has been an area where that's been true. For conventional debt, it's really not true. The debt fund structure as a floating rate deal, debt fund pricing, particularly on the smaller stuff, I'm not talking institutional, just doesn't compensate for the lack of banking availability. They don't slot in for each other easily.
And I cut you off there. You were explaining how debt funds and banks are looking at City of Yes and development right now.
Yeah, so I was going to say banks in general just not very open for business in terms of construction. Debt funds is where it goes more, and in that area, debt fund area, I mean, in that sector of the business, I think as long as the deal makes sense, they don't care if it's 485X, 421A, they don't care. Like, do the numbers work or not work? They don't have an agenda they're trying to fulfill. We need to hit certain affordability goals or certain part of our,
Right.
slice of our pie in construction. Does the deal work, right?
Derek, for City of Yes, how are you explaining to owners that the value of their property might not necessarily have gone up, or do you feel it has gone up because?
Well, look, I mean, it just depends on what we're working on at the given moment. I mean, I think it's all just a function of what you can build and then what's the prevailing price per buildable square foot in the area and what's the cost of capital and cost of construction. So I wouldn't say that prices have gone up. I don't necessarily think that's true. I think it's just a function of what is buildable at the current time. Something interesting maybe on the debt fund side of things. We've been negotiating for a lot of short-term closings, like 30-day time of the essence type of deals, or I just signed a contract. It should be in my inbox right now, 45-day TOE. And I feel like that's probably all private capital that's funding those transactions. And that's been a really interesting area for buyers. I think to get good value is to offer to close with a TOE, close quick with a TOE.
Yeah. Right, because everyone's afraid of the bank execution and a retrade, and so closing fast with, no debt contingency is great.
Yeah, especially on development. I mean, some of these guys will try to extend and extend. I mean, I had a different deal waiting for it to close. We negotiated a contract in September, and it's under a contract. I'm waiting for it to close, and the seller's been working with the buyer in this way, but a lot of these buyers will try to extend, and
Right.
I don't know. I've gotten lucky recently with some good buyers that have just come in, close quick, who've done it a number of times this year, and it's been great.
That feels nice.
To negotiate a deal and get paid on it, like in the near term, it's
also great because time kills deals, right? You let it hang out there. This changed for this person. This changed for that person.
Even the Mayoral race now, right? Like people will use anything, right? You just don't know what's going to happen.
Yeah, the faster you get it done, the better off you are.
Right.
For everybody. To your point earlier, from buyers who are hemming and hawing, and then someone else steps in. I feel like, New York City, like you said, attracts capital, attracts people. If you have a deal you like you got to get it done.
Yeah. I was with this guy from overseas last week before the mayoral primary came out. And I asked him, like, is capital from your country nervous about investing in New York at this point? Like, are people getting scared of like the socialist dialogue? And he's like, look, I take people to New York, and he's like, we walk around the city, and he's like, any building you look at, it's like, is this going to be worth more in 10 years? And people think it is. And it's the United States of America. It's New York City. So yeah, people want to place for overseas capital wants to be here.
And history has proven that to be the case, right? If you buy and hold in New York, you do well, right? Depends what time.
I think it depends on your time frame. To your point about the Bronx, if you bought in the Bronx in 1948, thinking this is the new up and coming part of New York City, all these beautiful new buildings, Grand Concourse, etc. By 1968, your investment was not worth more than you had planned, when you started. And you were that was probably true through 1988, right? So I think it depends a lot on the moment.
You have to zoom out a little bit to see where you're at.
You got to zoom out. And when you say a little bit, in the time horizon of a person, 20 years is not a little bit, right? You buy that building in the Bronx when you're 45 and you're expecting it to grow and provide for you and your family. And all of a sudden you're 70 and it's worth way less than you paid for it. And you've been carrying it some of the time. That's a real problem that, your grandchildren might be thrilled about it, but in your lifetime, that zoom out is harder to do.
It is, and you have to be empathetic with these folks, right? They've worked the businesses, they've bought the property, they've provided for their families with the mindset that this asset is going to produce for future generations.
Yeah.
Thankfully, there are options for them, right? It doesn't necessarily have to be a sale. If they haven't leveraged much, maybe they could refi, live to fight another day. It's not a
Live to fight another day is not the investment outcome that you're really hoping for.
right.
You know?
Right.
Yeah. But so I agree with you over the long term. New York's been great for a lot of people, but in the near term horizon of people's own lives, it's problematic. If you decided in 2020, I'm going to retire in 2025 and sell everything and move to Florida, your specific life is a problem, and what you spent your life accumulating and saving for isn't there.
Thank you for listening to the Broker Brunch. If you enjoy the show, please hit subscribe so we can reach more people.
Live to fight another day has become my mantra at pitches. At the end of it, I mean, there's not, for a lot of folks right now, there's not a good reason to sell in some of these markets that we spoke about. But someone brought it up to me that if you were saying that 2 or 3 years ago, it's actually got worse. So live to fight another day, depending on your time horizon.
Depends what it is. It depends where it is. It could be a very good time for certain properties or for certain owners, depending on their situation. And for others, yeah, like with the high interest rates in the banking environment, it's not the best time, but people are selling, and there's a liquid market out there. I think people should, if they want to sell, they should sell. Why not?
Buy us.
So IPRG.
No, 100%. Let's go.
Everyone. I like that enthusiasm though, and I think you're right. Ultimately, I think you're right. I mean, you gotta be confident. You gotta believe, and you gotta believe that there's as you say, a liquid market out there.
I've been doing this for 16 years, and I feel like I can't look at a single point in time when there's not like that arbitrage where there's that spread where buyers are willing to overpay for a certain type of asset class, and the sellers don't realize it yet. So there's more demand and capital than like historic values. There's always that angle, and if you can find those, there's a lot of, as a broker, there's a lot of money to be made in those type of dynamics, and I've seen it many times throughout my career.
Love that. We started off by touching on team building companies. Andrew, I always love talking to you about the grind. You're building it in real time. You're a very open book when it comes to this stuff. Appreciate that about you. Are you surprised by how hard it's been building Dansker Capital?
That's a good question. Of course, there's an assumption there that it's been hard, right? Which is a fair assumption. I don't think it's been easy. I think that yes. I think my answer is yes. I'm under anticipated and didn't fully understand the depth of the challenge that I was taking on. To your point earlier, where you said you like being a broker, I like being a broker sometimes, but I feel like I wanted a new challenge and a new puzzle to solve in terms of being focused on growing a brokerage, and I definitely got what I asked for.
Be careful what you wish for.
Yeah, really. I mean, I just passed actually the 5-year mark, which was this past January, and I think 80% of small businesses or all businesses fail within the first 5 years.
Really?
Yeah, the number is pretty stark actually when you look at the odds of success. And when I passed that mark, I really sat down and thought about the accomplishment of getting to 5 years, and I felt like I could see why a lot of people give up, can't do it, get divorced, turn to drugs and alcohol. Like, it all makes a lot of sense having gone through 5 years of trying to figure it out. But luckily, still married, not on drugs, and business is still there. So I think I'm winning.
I would agree from the outside looking in. You're doing it the right way. It seems like you're thoughtful in your approach.
5 years is still very early.
Thank you.
So tell us about that. So it started as Bestreich Realty Group.
Look, just when Andrew says 5 years, I was given the analogy when I started a business that like it's kind of like a kid, right?
Yeah.
0 to 1, you have like an infant, and then you have a toddler, and by 5, you have like a young child. But like that's basically the nature of your business. In my view, it's like a young child, and our company is 10 years old, and I guess it's starting to mature. It's still very young.
You have a teenager about to break out there in that company.
Sure. I hope not, but maybe.
Well, I only did this because you told me to.
I know.
It goes wrong.
So are you happy about that?
I would like to see it. Yes, I am happy about it.
That was a good launch.
Yeah.
Before we go down memory lane, when it comes to building a company,
Yeah.
it seems like IPRG has put a big emphasis on training it almost seems like, and to use your own analogy, there was an inflection point for the company, and now it's at a different level. You've got training platforms, you've got a serious management team, you've got partners. It looks like a company that's being built
It does, right? It looks like that from the outside.
for the big time.
No, it really does. Yeah.
Tell us about it. Like,
No, but on the inside, like, you don't know, right? You don't know what tomorrow looks like. You always have issues. I know it's looking back and looking at it from the outside, it looks really good, and it is. Yeah, I mean, it's really been just like live to fight another day, one day at a time. Like, just trying to make the best decisions each step of the way. And I mean, we've grown it very slow. We never took on, never raised money, never took on outside investors. We've run it kind of like just personal finance, like money in, money out type of thing. But it really started because when we were at Marcus, we felt really hamstrung or handcuffed by the house. And we were basically giving the house half of our money, and we didn't really know where it was going, and we didn't really see the benefit of the house. We knew there was some benefit, but we had a lot of trouble quantifying it. And the year we left, our team brought in $4 million gross. We basically paid the house $2 million. And I'm just like, there's stuff that I could do with $2 million. I'm like, we need a better database. I'm like, our database, it's just not going to cut it. And I'm like, we need better marketing. I'm like, we need better systems and resources in place. I hired my first admin at that point. That was in 2013, 14, 15, somewhere in there. So yeah, I mean, it was really kind of about taking control of 100% of the commission available. And, obviously the brokers get paid commission. I'm a broker, I get paid commission, but then having control of the back end, we knew there'd be expenses, right? We knew we'd have to pay for rent and technology, and we knew there was going to be expenses, but we thought, like, on a pro forma, we're like, well, I'm like, we made $4 million. I'm like, we're paying Marcus half. I'm like, I can give everyone better splits. I'm like, that would be great. I'm like, I still think there'd be enough to like pay for all the expenses and like get the stuff that we need so we can succeed and like still make a profit out of it and just control the whole, like, call it the brokerage capital stack. And so that's what we did. And it was very hard at first. Little did we know what we were getting into year one. We funded the company, self-funded, with me and my partners, Luke, Adam, Steve. We funded it pretty significantly, and we were running a really lean operation. We had a little office. It wasn't much bigger than this. It was out in Crown Heights, so like it was a tiny thing. And man, we went through that money fast. Like, we did not, and we were doing deals.
Yep.
We did not expect like to go through so much money so fast, and we almost ran out of money year one. Like, I was like November. We started the company in January, so it was like 11 months in. And our bank account was like a small fraction of what we started with. And we were on edge. We were arguing. It wasn't going well. And, I just live to fight another day. Just keep getting up and doing your thing. And, fast forward a few months, and the bank account started to get, on the brokerage side, the house side, started to get some more cash in it. Things started to, it's like a snowball, right? It's like you start packing it, and it's really hard to start packing that snow when it's like powdery and at first, and then you get a little snowball and you can start building it, rolling it, and yeah, it compounds. It's like the whole Warren Buffett analogy, but it's really true. And it was a snowball that just kind of started. And I can't speak highly enough about my partners. I mean, I have a really, really good team in place with the managing partners, and then even extended beyond that as well. But it's like a relationship. It's like a relationship with a girl. It's like you got to figure it out and find a way to, figure out, like, this is what I want. This is what I see, and this is what they want, or this is what they see. And how do we kind of land this thing and get on the same page? And
how do you coexist?
I mean, we didn't know each other, right? Like, I met Luke in 2011, Steve in 2013 maybe. Adam started working with us maybe 2014, but I knew him from college, but we'd never worked together. And so there's a lot of like figuring out our personalities, who's good at what works, kind of roles and responsibilities, and different people saw different things. And who's to say what was right or wrong? But different people made really important calls and decisions at different junctures, and it kind of led to where we are. And We started in Brooklyn. That was that. But Adam insisted. He's like, we have to be in Manhattan. He's like, nobody wants to be in Brooklyn. He's like, we'll never recruit in Brooklyn. And I mean, we had like 15 people in that office. It was a miracle. We were working in Crown Heights. They're taking the C train to Franklin, walking across Atlantic Avenue, and it was rough. It was rough. But yeah, so we moved to Manhattan. That was huge. That allowed us to recruit like the next, rung of guys. That allowed us to like start doing business in Manhattan. We hated the name of the company as Bestreich Realty Group. It was kind of just thrown together really quickly. We didn't like it. I didn't like it. Nobody liked it. But it was just like we had to get out of Marcus fast. So like that's what we did. We just ripped off the Band-Aid and went for it. And it took us a long time to figure out a name that we liked. And we were able to get Investment Property Realty Group. That had to be approved by the Department of State because the word investment is a restricted word. So we had to like get approval. That took a long time. We were able to get the website, IPRG.com. We paid $20,000 for that. That was huge though. I feel like getting like IPRG.com was just huge.
I can't believe you were able to get it, that it was available. It seems like
we got
that
it
would
in
be
like
really
2019 or 2018 or something, and $20,000 for a website with that kind of
big chunk.
It is a big chunk, but it's all about like having the house to make the right investments to benefit the brokers, and that's what this whole thing has always been about. And we had a nice office in Manhattan. It was 225 Broadway. That was like 5,000 feet. That was our second office. And we just saw a vision for ourselves, and COVID happened. We saw a vision, and we're like, if we're going to try to turn this into a real shop, like now is the time. And our lease is coming up is 2020. And we ended up finding a full floor in an office building downtown on a sublease, but is just an amazing office. It's fully built out, essentially built for us, built for brokerage. And, we took the risk. We signed that lease for full floor, 29th floor. It's sick.
I've been there. Awesome space.
Yeah,
It is a great office.
yeah. And then we had an opportunity to build a Jersey team. We brought on Yanni Marmaru, who is at B6. He came over, and prior to that, Zach Ziskin came over from Marcus, and he led our Manhattan expansion. And people had started just coming into their own. I mean, we started off as a bunch of young kids. I was the oldest at the company. I think I was 32 when we started IPRG, and Luke might have been like 26 or 25. And I mean, it was just a bunch of young kids.
When you think about it, like the probability for success was so low. Like if you had looked at that yourself, if I came to you with that business right now, you'd be like, man, I don't know.
The crazy thing is our underwriting was very wrong when we were leaving Marcus, because we were underwriting based on 2015 numbers, and that hold up for you. Yeah, I just read Bob Knackle's book, and Bob Knackle still talks about how like that was the peak.
That was
2015.
Right.
Like he says Q4 of 2015 is when like everything started to go down, and Q4 of 2015 is when we were gearing up to start Bestreich Realty Group.
Yeah.
And our timing couldn't have been worse, and it was really hard. It was a hard market going into 16 in the election year. So I don't know. I forget where the question started, but it's like a snowball, right?
It's like a snowball, and staying on that analogy. So Derek started very tough time. I mean, you could have done all the business planning of the world.
My business plan turned out to be off.
A global pandemic that really the world had never seen before.
That's right.
And you went into it, and it's actually just occurring to me that we're all Marcus and Millichap alumni. So yeah, we all are. But you left Marcus,
and that's a shame that they everyone ends up leaving. But sorry to interrupt.
Yeah, but on Andrew, leaving there, you saw an opportunity. You got well. Actually, let me tell you tell your story. I'm not going to say.
Yeah, of course, sure. You're right. My underwriting was off. I left in January of 2020. So when I opened my doors. So mid-January 2020, opened my doors, thinking, all right, should be fine. Did the rough math. Probably works. Let's give it a shot. And by mid-March, of course, we were all at home and the market completely shut down. So we spent 6 months kind of all at home wondering, when is the market going to open up? All the banks were closed for business. My underwriting was off. But like you said, we survived to fight another day. And I certainly think after that experience and then interest rate crisis, I definitely think it wasn't the basis of my decision in the way that it was yours. Like you said, you felt I'm giving away half. I want redirect this money to
Yeah.
grow. I was less focused on the money, although I definitely underappreciated the value of what I was getting from someone else carrying the risk, someone else paying the rent, someone else making the decisions. And I also wanted to control my own destiny and grow in a way that I didn't feel I was being able to grow. And part of that had to do with the control of that back end of capital and how it gets reinvested or not. So I agree with you. But I definitely underappreciated, the value of just, even in terms of my own time, of not being in charge, right? Today, I would say 70% of my week goes to coaching my team, training my team, or running my business.
Yeah.
And I'm down to about 30% of my week doing deals, which is a very expensive proposition if you're a capable broker, right? And I misunderstood or underappreciated the value of that time and how much work that was going to be and how much time that was going to take up to run the business when I started to.
100%.
Todd Cooper, who's one of the owners of Ribco, we were hiring a few people when we started the team, and he had this saying. It was hire slowly, fire quickly. And it's tough to understand that until you're actually doing it. But I think thoughtful hiring, rather than just throwing everything at the wall,
Totally.
is probably going to save you a lot of heartache.
We're back. Another season of the Broker Brunch podcast. Summertime in New York. We've got a lot of exciting conversations coming up. We hope you enjoy listening.
Absolutely. Absolutely true. Much easier to not hire someone than to fire them.
How do you attract recruits right now? Derek, I know a great sales training platform. Is attracting the right candidates as tough as ever?
The thing that I've experienced with brokerage is I can never tell if someone's going to be successful as a broker or not. I've had guys walk into our office that just looked like absolute studs. And I'm like, this guy is going to kill it. And the guy comes in 2, 3, 4 weeks later, they're like out, and they just had like just not the right mindset. I've also had other guys come in. I had this one guy, he came in, he interviewed. This is a while ago. I'm like, this guy's never going to make it. But I'm like, he knows someone in the office. I'm like, whatever, I'll give him a seat. Like, let's take a risk on this guy. It's no real downside. But I didn't really think highly of it at all. The guy came in, he was a killer, an absolute killer. And I didn't expect it. And it totally shook how I go about thinking on hiring.
Humbling. That's a humbling experience, I'd imagine.
So we have Zach Golub, who's handling all the recruiting and hiring and training.
Marcus Millichap alumni keeps going.
Another. Well, we love the Marcus alumni, and not that we're like trying to get them, but they've been attracted to us because Marcus, the way we came up back, this is 15 years ago, was pretty good. But I've told Zach, the only thing I care about when you're hiring someone, and this again goes to what Bob and Paul always said, is do you want to go and have a beer with them? That's literally the only things I care about.
Such a great litmus test.
Would you go and hang out with the person for an hour and have a beer with them? And that seems to work pretty well for us.
Yeah.
And then we'll hire them, and we'll figure it out. We'll figure out if this person's a fit or not, kind of down the road. But I can't do that before I have the chance to work with them.
Yeah, I think that's well said. My litmus test is a little different. I think about it as, do you appear to be capable for doing the job? And is there a risk you're going to compromise my reputation because you don't have integrity? If you don't have integrity, don't want you in my shop. Not interested.
How can you tell, though, when you're first meeting someone?
It's funny. I've interviewed people who've said things to me like, well, how much kickback do you get from the title people? And I'm like, I don't get any kickback. That's not legal. And they're like, well, everybody does it. I'm like, bye.
Yeah.
See ya. Not wrong shop.
Mhm.
I think people show you who they are if you're willing to ask and then willing to believe them when they tell you.
Yeah.
In my experience.
Mhm.
And I put it out there very loudly at the beginning. If you want to play this game in anything other than the straightest way, go somewhere else, because I'm going to fire you as soon as I find out that you're doing it. But I think in terms of surviving in the business, to your point, I tell people I'm recruiting that there are 3 components to survival. One is following the plan, one is doing so consistently, and one is not giving up. And like you said, you can't see that in a person. And I think it's not always clear to them the answer to those
100%.
questions.
It's not.
People think, well, I'll follow Andrew's plan, but I also have another plan. Okay, well, my plan is making money for all of these people, and you've never done this job before. maybe you should follow my plan, or they do it, but they can't keep it consistent. They get, dejected or discouraged is a better word. They're sort of hot and cold, or they just give up.
Yeah.
And it's hard to account for that in an interview.
And that's the thing you really got to watch out for, because you don't want to have that kind of sentiment in the office.
Yeah.
Discouraging people, like the water cooler talk or bathroom talk, where people are saying this is so hard, this sucks.
Yeah.
I'm getting, yelled at every day. I hate this. Like those people, like you gotta,
If they suck the energy out of the
they have to go.
Yeah.
Yeah.
And on that office topic, how important is an office to building a team and building culture?
Non-negotiable. If you want to work from home, you're destined for failure. That's my opinion.
Couldn't agree more. I mean, you have to be in the office, like the camaraderie, the information. Like we have a bullpen.
That's right.
We don't even have private offices. The only person that has an office is Zach, who's handling recruiting and hiring and training. But otherwise we're in the bullpen, and I just love that energy, and that's where you get all the information in terms of
passive flow of information, tone, strategy, what's going on. You can't get any of that at home. You miss that entire component of your education. I'm with you 100%.
I will work from home occasionally for like an hour or two, because in our office it's so loud and there's so many distractions. Like this is your seller, this the next thing, and I'm like I gotta think straight for 2 seconds.
Yeah, I think
that's different.
I think offices are getting and landlords are getting cognizant to that you need a bullpen, right? But then you need the executive space, right, to go in and, like you said, Derek, have 15-20 minutes of uninterrupted thought to actually bang something out. Andrew, you can relate to that, I'm sure. When it's not business origination or cold calling, it seems like the office of today needs to account for collaboration in the bullpen, but also have downtime for actual doing of the work, for the nitty gritty checking boxes with tasks. Is that what you're seeing in the offices of today, or is it all just stay in the bullpen and bang phones?
I think it depends, but I definitely would agree that everybody should step back from time to time and think about what they're doing. Because if you haven't thought about what you're doing, you're just doing it over and over again, you can't grow. You've got to have time to step back. And that has to be a quiet reflection. It's not about just make more calls, but it's about, why am I making calls? Which calls are working? Which owners am I connecting with? What are the venues in which I'm connecting with them? Where am I finding success that I can build on? I feel very focused in particular on efficiency. And that's something that we talk a lot about in my office, about you've only got so much time, right? And the amount you can make is controlled by how much of that time you have to spend to originate a deal, how much time you spend to execute the deal, and how much time you lose on deals that don't go anywhere, right? And so there should be a point, it can't be every day, but there should be a point at which any broker who's trying to grow steps back to say, how could I spend less time originating, right? Which involves cultivating repeat relationships, of course. How can I spend less time executing, which of course is about how do I learn to delegate better, which is a real skill set. But if you're not stepping back from time to time, you can't grow, right? At least in my opinion. So I think being in the bullpen is critical to absorbing information and the skills of the people around you. But yeah, you definitely need time to step away.
Derek, how do you foster that competitive spirit within a company, especially in the bullpen, but also balance it with collaboration and sharing of information?
I mean, we have a good team structure in place where I think people hold each other to a high standard. But I mean, just one of the things for IPRG, I mean, one of our core principles is winning mindset and deal makers. And so we expect people to come in just with the intention to win, like ready to go each and every day. And we want people that are deal makers. And I don't know, you got to expect a lot of yourselves and of the team. And I think the energy in the bullpen really helps to go a long way to just, even if someone's not on your team or working a different borough, you see them and they're making the call.
Totally.
And you hear what they're doing. And I mean, so we've stopped ringing the bell as much. We see people ringing the bell, or people are getting listings. And, we do the training with the associates where they're all together and they're doing the activity tracking, and you see who's making calls and who's getting meetings and proposals and listings. And you want to have that competitive nature, but what we don't want is where it's like cutthroat competitive, where people are taking from each other or stealing from each other, which is what we started to experience at Marcus, where they had teams on top of teams on top of teams, and that was all designed for like company maximum profitability. But what it ended up doing is it killed the culture. So, for us, like we don't need to make as much money as is possible. We just want something good. We want something cool where people are comfortable. And so we have teams and territories, kind of like the Massey-Knackle structure. And we have agreed upon splits in place, which incentivizes generation. So even an associate that generates an opportunity makes the most money on the deal, regardless of what else happens. Like, all they have to do is get that meeting. Someone else goes and pitches the deal, handles the client, brings the buyer, does due diligence, you name it. We incentivize the generation because we feel like that's the most valuable part of the brokerage continuum spectrum. So we have splits in place to incentivize sourcing the deal. And then we also have structures in place where it's like, what if someone else lands on the deal that person was on a while ago? How does that work? So we have it all. Like, we've kind of been through it all. Like, we've seen it all.
Trial and error.
Yeah, we've done a lot of deals. We've seen a lot of situations. So we have it all figured out. We have a good system backing it all. But I mean, look, I'll try to like motivate people here and there. And I think that I'm reasonably good at it, but like, I don't want to have to motivate people. I want people that are in it to win it and that are entrepreneurial and that have high expectations of themselves.
I don't think you can motivate people. I'm a big believer that you come in as who you are, and your competition is ultimately with yourself. And I, as a person, I will find someone to compete against, even if they're imaginary, right? Just so that I can win and keep going and do more. And I've always felt like I don't care what anyone is doing around me. Here's where I'm going, and I'm headed there. And I find people are like that. Either you're on your path or you're not. And I'm not going to like inspire you to start hustling, because this business is hard. It's a hard business.
I think that's I love you saying that your biggest competitor is yourself.
Absolutely.
It's so true. And I work so hard to get like that stuff out of my own psyche. And like, so by the time that I'm ready to be in the office, I'm like just ready to rip it. Like, I'm there. I feel like the guys in the office, it's like professional athletes. Like, that is the field of play. And you step onto the court or onto the field, and like, you better be ready to play all out. And that's what I expect when people enter our office, is they're ready to play hard.
You can't coach someone enough or monitor someone enough or manage someone enough to get them to succeed in our business. I don't think. It's too hard.
It makes sense.
There's too many cracks to fill in. You just can't get there.
Yeah.
I've never been able to. Maybe someone who's a better manager than I am.
So the team structure helps as well, because if people start to get off track, like, the team knows and the team steps in.
And there's value there.
Yeah,
I agree with that.
And I also like having the teams, because it's kind of like, I don't have to like micromanage or oversee too much. Like, I have people in places where like I know what's going on. And if I don't know firsthand, like the information gets to me quickly, or it gets to the relevant places really fast. So we have a way to like keep a handle on everything and make sure everyone's rowing in the same direction.
Yeah, it's funny, to your point about keeping a handle on things and knowing what's going on. I was talking to someone recently about management and managing a team of brokers, and I compared it to becoming an experienced broker in terms of doing deals, right? Where in my first few deals, I was on every email, I was talking to the borrower every day, the banker every day throughout the transaction. And now I've delegated a lot of that work. I have an analyst that'll put together the book, send it to the banks. I have a processor that will close the loan, right? I'm not getting worse outcomes. I simply have become a better broker in that I need less information to arrive at the same conclusions. And I have felt the same experience as a manager, right? With the first people I trained, I spoke to them every day. What are you working on? Who are you calling today? Where are you going? What event are you going to tonight? And I feel like my ability to keep a finger on the pulse of what's happening in someone's business has gotten better in a way that I can take much less data and see what's going on. I don't know if you feel that way or if you've experienced that, but it seems like that's sort of what you were saying.
Yeah, I mean, I want to work with people that I trust and that I could trust to do the right thing and to work hard and to do what they need to do, and people that are entrepreneurial. And I think the company has the proper incentives in place and structures in place. But yeah, I mean, you can't, if you're going to be that deep in the weeds, you'll never be able to grow.
Can't. Not possible.
So I agree with you.
But it's interesting that your instinct first time around is to micromanage.
Yeah. I just think I lacked the ability to manage without micromanaging because I didn't know enough, right? And that over time, I've gotten better at just knowing what's going on and seeing the little clues that lead me to the information I need.
The performance indicators you're looking at rather than the everyday blow-by-blow information.
I can see, you guys are brokers, you can relate to this. If someone's in November and they're closing a big deal and the pipeline's empty for December and January, they're looking back at a great year. They're pretty nervous about the bagel that they're facing coming up, right? We all know that. We've all been there, right? But you don't know that as the first time you're training someone or whatever. But, 15 years later, I know what's going on in Q4 and I can see, people getting nervous and what's going on and where to check in. Some of it's just actually experience. I think as a young broker, maybe just a young person, I discounted the value of experience and I was like, I'm smart. I know what I'm doing. Maybe there was a little hubris in there, but I think now in retrospect, I can see, I actually know a lot better what I'm doing than I did. And I really didn't know what I was doing in the same level.
I think part of it is having started at like the ground floor and gone through all those phases of like being a broker that, now you can identify it and you know it and you've experienced totally. See it in others. You can help guide people.
Yeah. Because a lot of it's very visceral. You can't even understand it unless you've been through it. Exactly. And to your point about people quitting, I start out by telling people this is a very hard job. You're not going to get paid for a while. And around month 6, you're going to start wondering if you've made a terrible choice and if I'm out of my mind. Now, if you keep doing it, you'll make money or you can give up. Those are the options at that point, but you will feel that.
Yeah.
Right.
For sure.
So we have to wrap, but in closing, we're going in, it's halftime, right? We're July 4th weekend, 2025. Champions are made in the second half. Derek?
Yeah.
What's one thing IPRG has to nail for the second half of 25?
We have a lot of deals that have been going under contract. That hasn't been the issue in terms of finding the opportunities and getting them signed. For whatever reason, right now we have like our biggest pipeline ever of deals that are hard under contract, but they're not closing. And I wonder if that has to do with the financing environment or whatever. But
Well, you can call if you have a problem with that, right?
I don't know if we have a problem.
Yeah.
It doesn't seem like it.
Oh, there's one person I know that could tell you.
What do you mean?
It's not him.
Yeah.
Yeah.
Well, I mean, these buyers could tell us, but what we have to do.
We're here, Derek.
I mean, I'm still open for
He
business.
has a platform.
We have to get our deals closed. We have to get the deals closed, and then have to keep building the pipeline.
So you got to get those deals to the next stage that are in contract.
Get them closed.
Get them closed. Get them closed. Love that. That's straight broker talk right there. Andrew Dansker Capital. Lots of interesting things, I'm sure, coming in the second half of the year. Where do you see the firm going for this next iteration? Call it year 5 to 6.
Yeah. So I am always someone who's focused on what track am I laying for the future. What I'm doing now is the result of yesterday's work in my mind. You said we're at the halfway mark. In my mind, we're like 90 days away from the end of the year. Q3 is baked. Q4, whatever happens, is mostly going to be a result of relationships that already exist. I'm looking at what am I doing for 26 and 27. That's what's happening for me in the last half of 25. That's just how my brain works, and that's how I operate. For me, that is building infrastructure for scale. I think that I've been really fortunate through a variety of circumstances that the way in which I built my brokerage business, as in me being a broker, turned out to be something replicable and scalable. And I was very fortunate through the encouragement of a good friend to open an office and do that and replicate that. And then from there, I was able to replicate and scale in other offices, and we're up and running in South Carolina and Florida. Now the question for me is, all that infrastructure is there, that is replicable and scalable. How do I take advantage of that infrastructure to, say, be in Boston and Bethesda and New Jersey, whichever city that ends up being, Pennsylvania? I mean, the rest of the East Coast to me is the same fertile ground as the territories I'm already in. So my can't miss target for the end of this year is make sure my infrastructure is in place so I can do my business plan in 26 and 27, which is continue to replicate and scale a proven business plan.
Andrew, Derek, I appreciate you both.
Thanks for having us.
Thanks, Brian.